Okay, GoviEx. I'm going to pass our first slide. There we go. Right, GoviEx, Africa-focused uranium development company, very large mineral resource. We turned the drill rigs back off in 2013, decided that with the amount of pounds that we had in the ground over our projects that we had more than enough to justify going into development. Any future drilling would be additional to it. We've been a consolidator in Africa as well. We started our original project in Niger and then added Zambia with 2 projects and then added Mali as well. We like Africa. We like working in Africa. It's pragmatic. Pick the right countries, work with a mining code. Niger's mining code has not changed since 2006. It's driven by OHADA as well, which is the West Africa business law. It's consistent over the whole of West Africa. And in particular, Niger has a mining code that is very FDI driven. We've just done a transaction with the Nigerian government where we have basically got them to agree to take a 10% stake in the project in exchange for $14.5 million. So very pragmatic in the fact that they need us to go into development because 60 to 70% of the exports is uranium, but one of their major 2 producing mines at Cominac is due to close in 2021. So very much the place to go from our point of view. A commentary on the uranium market. I think my summary of this year has been that the fundamentals to the market have been excellent. We've had great improvement on the demand side and the supply side, yet it hasn't come through to the metal price itself. So if we look at the demand side and you look where this is the World Nuclear Association's nuclear fuel report reference scenario, what you've got here is a 2% growth, and this is very different from where they were 2 years ago, where they were actually in the low case looking at a decline. The low case now is actually still showing growth. Why? The French government were looking at taking current power generation from nuclear from 75% down to 50% by 2025. They've now deferred that out at least beyond 2035 and probably going to extend it further, particularly after the French government asked EDF to put in 6 new design costings for 6 new plants. US has been the biggest change. Most of the US states that have reactors now get subsidies for the green energy on those reactors. There have been a number of court actions against those. They have all failed. The most important thing is that now you've got that protection for those reactors. The reactor utility companies are now looking for extensions on their reactors from 40 years life out to 80 years of life. So you're getting a very solid underpin. That's 25% of the world's fleet. This forecast here of 2% growth is on the existing 440 reactors continuing as they're going. It doesn't assume any major changes in Japan. We're expecting more reactors to come back on stream there. All it includes is the existing 55 builds that are currently underway. So this is a very good underpin. On the supply side, though, we've had a completely different scenario where we were in oversupply, production cuts by Kazatomprom, and more importantly, Cameco have taken the supply into a supply deficit. So we are now looking at a scenario where inventories are being pulled down. We're seeing that particularly in the US and in the European market. You've got a decline in secondary sales coming through. What this chart is showing as well is that you need to have restarts to fill the market. The important point here is that Cameco will not restart the McArthur River mine unless they're able to secure contracts around $50. Contract price is only $32 at the moment. In addition, Kazatomprom will not accelerate their production back either unless McArthur River starts up. So your 2 major producers are holding production out of the market in a considerable basis. What Cameco also said they would do is they would buy metal out of the market. That's what we thought at the beginning of this year was going to drive the price. Unfortunately, 2 of the US producers decided to put a spanner in the works and do what was called Section 232, which was a defense review. What that effectively did was stop all the US utilities buying anything because they didn't know what to do, because they didn't know what the rule game was going to be going forward. Section 232 finished 90 days ago. Unfortunately, they decided to kick that down the road rather can-kicking exercise. We're looking for the final result to come from that. What you've seen, though, is the utilities are giving up and actually coming back into the market. So we've seen a shift recently where the utilities are now becoming a buying market rather than a selling market. More importantly, Cameco, who were supposed to be buying in the market, decided to draw their inventories down instead, halving their inventory position. They are now back in the market. And so in the last week, you've seen the uranium price jump up $2, 10%, and we're starting to see that movement back forward. So we're looking for a fairly fundamental step forward in the uranium market. I think it's starting to go. So where does that put GoviEx? We're a development company. So for us, it's getting our Madaouela project going and then following that through with our Mutanga project. It's Madaouela, right in the middle of the Sahara Desert, but most importantly, it's right next to Orano's two mines. They've been operating since the early 1970s. They produced about 140,000 tons of uranium, about 8% of the world's supply. That's what it looks like. It is really boring and brown with the occasional camel. But what it does bring us is all the infrastructure. Roads are there, power's there, lots of water, but more importantly, with Common Act closing, there's a workforce looking for jobs for the future who are fully trained in mining and the processing of uranium. So the key parts there. This is the existing project as it currently stands. It's currently 21 years, producing about 2.7 million pounds. All-in cost is 36 with a cash cost at 24, just under 25. What we decided to do last year, though, was my view, looking at what Cameco wanted to do, was to restart around $50, as this project has to be made to work at $50. It currently works at 55. So we've gone back and reset everything that we do on this project. We had some inherent risk from a design point of view. We stripped out those risks from a technology point of view. They were there because they were keeping our costs down. But we found non-risky ways of doing that, which are actually reducing our costs even further. So we've changed the front end, put gravity in. One of the benefits of uranium is it's really heavy, and we're able to strip out the uranium, but at the same time remove the calcite, which consumes a lot of our acid, and it's one of our major consumables. We also have quite a large chunk of molybdenum comes out of this property as well. We had to put in an innovative solvent extraction plant to make that work. Technology, again, has moved forward with an IX process, which works more effectively and a lot cheaper than the SX proposal we had in here as well. So we're making some big changes on the design, and the other area we can now go to is contract mining, which was not available originally back in 2013, 2014, which, if we can get it to work, strips out about $25 million of mining capital that's not really needed on this property as well. So we're making these big changes to get that down and make this project debt financeable. The debt banks are interested in this project with an export credit-backed facility going. So this is very much where we're going. Focus of getting this into production. It's fully permitted. We don't need anything. We just need to sort the financing out. We have Zambia. This is a bit more flexible. It's a very easy open pit operation. All-in costs are very similar to the all-in costs for Madaouela. It's an open pit heap leach, a lot of exploration upside on it. The same as in Niger. We could easily double our resources on these two properties just by infill drilling between our properties. So this one's 11 years to start with, producing almost the same amount as we got out of Madaouela, but at a third the capital. But it's got a higher operating cost because of lower grade, and hence the reason we focus very much on Niger. Management, we've all been in the industry for far too long. We all have a lot of history, either in uranium. I've also been an equity analyst and a banker as well. So we've got quite a spread of knowledge, and that applies to our board as well. David Cates, who's here at Denison's, one of our board members. Benoit Lassalle is very much a key guy for us. He's the founder of Semifo, knows everybody in West Africa. So a strong board with a wide spread of experience coming through. We do have the major shareholders with Denison there. We're fairly liquid with a split between retail and institutional on the spread. There is a debt on this slide, but that debt no longer exists. That's what the government agreed to convert into equity at the project level. Their valuation for our project on that conversion was $145 million, and we're trading at $45 million. And then really just the last slide for you. This is what it's all about, is that ability to go from being a developer to being a producer. The last cycle, Energy Fuels and Paladin outperformed the sector more than anyone else. What they did was build mines in the cycle. They were the only two that did. So GoviEx very much in the same place. Thank you.